So for the past couple days, all over X, I have seen this company that just did upwards of like 30% on one day. And I'm specifically talking about, guys, the company Opendoor Technologies, which you guys can see right here. It is up 221.77% in just 1 week. Absolutely insane. Is there any stop to this? At this rate, it'll be back to my average cost in no time. In fact, look at this, guys. 1 week, 221%. And if we actually take a look at this on the 1 day, we can actually see that the company is upwards of like 33% and then 17% post market. Now, this company is actually really interesting. For starters, it is a company that is similar to that of Zillow. However, it is a little bit more niche than that. Actually, it's what Zillow tried to do and failed. And we're going to get into this in just 1 second. So taking a look at now Opendoor Technologies company profile, we got Opendoor Technology operates a digital platform for residential real estate transactions in the United States. It buys and sells homes. So if you're Gen Z, this already hits way too close to home. In fact, it kind of just hits on that nerve a little bit right there. The company offers sales to Opendoor products that enables homeowners to sell their home directly to it and resell the home to a home buyer. Very interesting. List of Opendoor products that allows customers to list their homes on the MLS with Opendoor and receive cash offers, and Opendoor marketplace products. This is the key one right here. And Opendoor marketplace products that connects to the home seller with an institutional or retail buyer. It also provides real estate brokerage, title insurance, and settlement and escrow services, as well as property and casualty insurance, real estate license, and construction services. The company was formerly known as Social Capital, oh my goodness, Sophia Holdings Corp, and changed its name to Opendoor Technologies. So if you guys remember still going on, but even a few years ago, there was a big hubbub of BlackRock, all these institutions buying homes, and people were like, they should not be allowed to do this because people that are just wanting to buy to start their home, they can't afford to start their home because all these institutions are buying them up. These guys are the cause of this. These guys right here. In fact, notice that iShares by BlackRock up here. This was very, very interesting and confusing when I just saw it. And I'm like, why in the world does it have BlackRock? Why? This is interesting. So I asked Grok as to why this was the case. And it basically said the reason that iShares by BlackRock is mentioned on Opendoor Technology seeking alpha company profile, it is that BlackRock, through its iShares exchange traded funds, is a significant institutional holder on Opendoor. So guess what? When you guys use Opendoor, when people use Opendoor to sell their homes, guess who they're selling it to? They're selling it to BlackRock. Actually, it's even worse than that, because they are kind of hiding the fact that they are selling it to BlackRock. So people sell them their homes thinking that they're just going to eventually sell them to somebody else. And then BlackRock, that owns them, at least they're a majority shareholder of Opendoor, then Opendoor sells the home that they just bought from the homeowner to BlackRock. It is actually very schemy. Now, you guys know that when it comes to investing, I personally believe there is no such thing as moral investing, because it just depends as to where your line is. But if you're Gen Z or even millennials to some extent, and you all had an issue with the whole BlackRock buying houses, Opendoor is the catalyst. Opendoor, it is the middleman to this. I don't want to get too much into that, but just letting everybody know that, yeah, this company is very, by the looks of it, it's very, very sleazy. And if you are Gen Z or even millennial, it does hit a pretty bad nerve right there. Nonetheless, though, let's take a look at what's currently happening with Opendoor. In fact, we can see here that, on Friday alone, this thing gained 36.36% and post-market 17.77%. We can see that they were on the 1 year, they were just crashing. 52-week range of $2.66, as you guys can see right there, to a low of 51 cents. So they were always a penny stock. For all of those of you who do not know, a penny stock is a company under $5. they were actually a penny stock, right? Not just by definition, but actual, because they were 50 cents. Absolutely crazy. And as of recently, we can see that they just had a massive explosion, going from like 50 cents all the way up to what it is now of $2.25. Now, this is actually even more interesting because if we go to a year to date, we can see that they're up 40.63. However, this was a company that was a meme stock back in the 2021 era. Look at this, guys. Look at this. Actually, let's expand this to the 10-year to get the full view. Yeah, look at this. In June 2020, they IPO'd and they had a massive surge going all the way up to, look at that, $34.59. And they just completely crashed afterwards. So this was definitely a meme stock back in the day. And I'm really curious to see how their fundamentals actually shape up. Now, if we actually take a look at their earnings, we can see Opendoor Technologies GAAP EPS of -12 cents beat by 1 penny. Revenue of 1.15 billion beats by 90 million. Now, this 1.15 billion is an increase, it's a decrease year over year of 2.5%. Gross profit of 99 million versus 114 million in Q1 of 2024 and 85 million in Q4 of 2024. The gross margin was 8.6 versus the 9.7 in Q1 of 2024 and 7.8 in Q4 of 2024. Net loss of -$85 million versus the loss of -$109 million. So you can see that they did lose less than what they were expecting. Inventory balance of 2.4 billion, representing 7,080 homes, up 26% up 26% versus Q1 2024 and up 9% from Q4 of 2024. Purchased, wow, guys, this is really terrifying. Purchased 3,609 homes, up from 4% versus the Q1 of 2024, which was up 22% in Q4 of 2024, and in the quarter with 1,051 homes under contract for purchase, down 60% versus Q1 of 2024 and down 38% of Q4 of 2024. Scrolling down, we can see the second quarter outlook. Q2 of 2025 revenue guidance of 1.45 billion to 1.525 billion, contribution profits guidance of 65 million to 75 million, adjusted EBITDA guidance of 10 million to 20 million, and revenue consensus of $1.45 billion. And if we actually take a look at Seeking Alpha versus Wall Street when it comes to analyst ratings, we can see that they're both at a hold, though it's a little bit different. We got Seeking Alpha analyst ratings, only 2 authors in the last 90 days, one of them saying a sell, the other one saying a hold, all for a total rating of 2.5 or a hold. Same thing when it comes to Wall Street. However, 10 analysts now, we can see that one of them was saying a buy, 7 of them are saying a hold, and 2 of them are saying a sell for an overall rating of 2.9, which is also a hold. And if we actually take a look at one of these articles that puts the company at a hold from Stephen Ayers, Opendoor is still a speculative play, but with better odds. And if we actually take a look at the summary, we can see Opendoor faces NASDAQ delisting, warning requiring reverse stock split after a 48% decline since previous sell rating. Q1 of 2025 earnings beat expectations, as we saw, with improved margins, reduced losses, and first positive EBITDA projection. The company pivoted to asset-light agent partnerships, earning of referral fees, acknowledging iBuying unsustainability. Funny, because that point right there is the same reason as to why Zillow was going through a lot of turmoil, I believe, during 2020, because they tried doing the same thing and they figured out that, yeah, the whole iBuying thing, it's not sustainable in the slightest. So the fact that they are now switching to asset-light agent partnership, earning referral fees, and acknowledging that it doesn't work, well, Zillow already kind of went through this. A strategic shift from capital investment iBuying model to asset-light agent partnership earns it a cautious hold upgrade, which is similar to what we just saw with Seeking Alpha analysts as well as Wall Street. So now let me throw my ring into the hat as well. We got the ticker for Open, OPEN, market cap of $1.64 billion with a current share price of $2.25, as I just showed you all, up 36%, absolutely bonkers. No PE. Wait until you guys see their fundamentals. It is bad. no dividend either. And we can see that the price to free cash flow is currently negative 2.29, past 5 years positive 3.5. Yeah, it's concerning. Again, a lot of stuff will come to light once we get into the fundamentals. Price to sales only 0.32 and net profit margins of negative 7.18. So now taking a look at the net income, we can see that 2020 was negative $253 million to today of negative $368 million. That is a decrease of 45%. And not to mention, guys, I mean, if you take a look at this, they dropped massively in 2022. They went back up, but right now they're actually lower than what they were back in 2020. So overall, I'm going to have to give it, I mean, it's getting better, don't get me wrong, but I want to go with like a 40%. Not that good. Then we got the free cash flow. Actually, the free cash flow is in the positive, ironically enough, going from 2020 of $665 million to the trailing of negative $717 million, a decrease of 208% with an average of negative $583.17 million. Now we can see that this is it's very 50-50, right? It's like, yes, there was a major drop right here in 2021, but you can see that it's just very stagnant, really, really unappealing. I'm gonna go with a 50% on this one. Then we got the revenue. We can see that, well, we went from $2.6 billion in 2020 to today of $5.13 billion. This is an increase of 98.41%. Overall, though, we can see that it's not impressive, right? It just really isn't that impressive. It peaked in 2022 and then just slowly just petered out. I'm going to say a 60% when it comes to this, because it's just, there really isn't anything to see here. Then we got the assets. They peaked in 2021 and then just falling as of today. Liabilities as well. Assets minus liabilities are basically following that pattern, where today is actually even lower than what it was in 2024. Average total assets of $4.7 billion. Liabilities of $3.51 billion. This is a difference of $1.2 billion in the positive. I don't like this decrease, so I'm actually going to reduce this to about like a 50% because I don't necessarily know where this is going. Then we got the cash flow minus liabilities. Actually, not that bad. We can see that there are some instances where it was actually in the positive, as you guys can see right there. And yes, they have had issues, don't get me wrong, but in general, it's not looking too bad. The trailing, it is negative 3.35 billion. And the average is negative 4.1 billion. Not too bad. I'm gonna have to give this like I'm actually gonna have to give this like a 90%. It's actually really, really good. Then we got the shares outstanding. This is not surprising that this is increasing at a very steady rate. Not really surprising in the slightest. This is an increase on the 5-year, my bad. It's an increase on the 5-year of 34.42%. That's a lot. And previous year to the current year is an increase of 6.26%. And we could assume that this will continue to happen in the next 5 years, seeing that that trend line is hitting those graphs every single time. I'm going to have to go with a 50% on this one. It could be a lot worse. And then we got the cash and equivalents, and we clearly see that they are at $671 million with an average of $1.1 billion. Overall grade, we can see that it is at the 54%. It's slightly better than half. It really is. I'm not necessarily a fan of the fundamentals. I'm just really not. So let's see what the discounted free cash flow says as to what we should pay for this company. Now, if we actually take a look at the discounted free cash flow, we can see that we are actually somewhat close to this share price of $2.25. Average revenue to free cash flow growth, negative 74.36. I'm going to say that for the next 5 years, they're not going to be this bad. They're going to be in the negative, but they're not going to be this bad. So I'm going to say roughly at around like negative 55. Then let's go up to negative, oh my goodness, let's go up to negative 50. Oh, sorry, negative 50. And then for the highest assumption, let's go to negative 45. I think that's very, very fair. Then for the net income growth, we can see that the average, it is at 44.56%. However, we saw the overall graph when it came to the fundamentals, and it's kind of just not doing anything. So I'm going to have to say that for this specific net income growth, we are probably going to see stagnation. We probably are going to see stagnation. So I'm going to say something along the lines of like, in the next 5 years, I'm gonna say the positive, but I'm gonna say something along the lines of like 5%. Then let's go to 8%, and then let's go to 11% when it comes to the net income growth. Okay, then we got the share change. Guys, I honestly think that they're going to continue this. I honestly do foresee that. At worst case scenario, for the low assumption, I'm going to say that they're going to increase it by a whole lot more. I'm going to say that they're going to be doing something along the lines of like -12 in the next 5 years. So they're going to really ramp it up. At best case scenario, they're going to keep it, or the median case scenario, they're going to keep it roughly the same at around 6%. And the best case scenario, they just won't issue any shares at 0. Yeah, we got some interesting numbers here. $5.82 all the way up to basically $30, right? $29. And if we actually take a look back at that Seeking Alpha overall highest share price that we've gotten, we can see that that $30 mark would basically put us at the peak of what it was in 2021, or roughly so. Does this mean that this is 100% going to happen? Not really, but it does give you a perspective that there is a massive just overall gaps between the assumptions, because we really have no clue as to what to go with, right? Even the PEs, on the lowest assumption, a PE of 25, and the highest assumption, a PE of 45. And right now, PE is NA because net income is in the negative. So who in the world knows what this could actually be like? There's a lot of uncertainties going on with this company. And me personally, I like to buy a company that is at least looking on the upside. I took a look at Oscar and I did not see this. It's kind of similar when it comes to the fundamentals, yet if you guys see that video, which I highly encourage you guys to see it, it's a completely different thing, right? So that's just the way that I see it. And when it comes to this, it's definitely not my favorite. And on top of that, as I mentioned at the beginning, these are the people that sell houses to they buy houses from homeowners, then sell the same houses to BlackRock because BlackRock owns them. So just keep that in mind. And again, not financial advice. Every investment is the present value of all future cash flow, guys. The calculator you guys see right here, it is available for all of you guys to use and have for free. The link to this in the description below. Feel free to use it because at the end of the day, not financial advice. This is for entertainment purposes only. So all in all, when it comes to Opendoor, interesting, I guess. It's an interesting company. Not my cup of tea. Could this thing have a massive pump up? Yes, it can. But you know what, guys? It had a massive pump down back in 2021 to what it was. It was actually a penny stock, 50 cents. And now people are, oh my goodness, it's back up to $2. It's still a penny stock, guys. So be very careful if you do invest into this, because the red flags are all over the place. Could you benefit from it? A whole lot, yes, but there's a lot of risk, so just keep that in mind. But anyways, that pretty much does it for this video. Make sure to like, subscribe, comment. Really does help with the algorithm on YouTube as well as Rumble. Make sure to follow us on X at Fatal Investing, and of course, if you like join us on Discord, the link to this in the description below. So with that said, peace out, and we will see you all next time.